Hi everybody, you might have observed that some businesses always trade at very high PE multiple. These businesses keep on increasing their sales and profits. Have you ever wondered why that happened? In this video, we will look at how some businesses are able to maintain their margins over the long term, how they are able to grow their business without borrowing money, and how they are able to consistently generate high return on capital. Let's start the video. Warren Buffett made two investments at different times. In 1972, he purchased a chocolate brand called See's Candy for $25 million. In 1993, he purchased a shoe company called Dexter Shoes for $434 million. Now, investments usually are done to grow the capital, and Warren Buffett did these investments with the same intention. As it turns out, his investment of $25 million in See's Candy returned more than $1.3 billion by 2006. On the other hand, his investment of $434 million in Dexter Shoes went to zero. The question is, why one investment returned massive value and why other investment turned out to be a loss? Well, Warren Buffett has himself given an answer to this question into his letters to shareholders, and the answer is pricing power of a company. See's Candy is so strong business that it is able to increase the prices of its products without losing its customers. This ability made the business generate more than 200% return on its invested capital. However, in case of Dexter Shoes, global competition turned the shoe business into a price war. Dexter Shoe was not able to increase the prices of its products without losing their customers, and so margins slowly collapsed, and so the investment into this company. This story teaches us one lesson, and that is the presence of pricing power tells us that the business has a sustainable competitive advantage, and investment in such businesses has potential to create massive return in the long run. So let's understand the pricing power in some detail. Pricing power is the ability of a business to increase the price of its products without losing customers. Pricing power is very significant for a business because of following three reasons. Firstly, it protects profits when costs rise. Costs like raw material, freight and energy cost may rise unpredictably. If a company can't raise price, then its margin will get collapsed even if the sales increase. Secondly, a business with pricing power can often grow its profits without constantly needing new capital. Pricing power ensures that there is no need to provide any discount to sell the products, which in turn creates strong free cash flow. And lastly, when company can charge more for same volume of products, it usually gets higher margins, which in turn creates high return on capital. So, summarizing the above points, pricing power lets the business protects margin, enables a strong free cash flow, and creates competitive moat, which makes the business of very strong quality. Okay, so far we have defined what the pricing power is and why it matters. But the real deal is how an investor can identify whether the company truly has a pricing power. So here are the three filters that investors need to look at to identify whether a business has a pricing power. First, after a company does a price hike, check if sales volume stays stable or decreases. If volume get crash and stay weak, that means customers are switching to other options. Real pricing power comes when brand can increase prices with limited volume damage. Second, see what happens to gross margin and operating margin after a company does a price hike. When there is no pricing power, margins keep shrinking. That means market didn't accept the price. And when there is pricing power, margins hold up and even improve. And third, look for the signs of market share loss or heavy discounting just after the price increase. If company is giving discounts to sell its products, that means the price increase is not sticking. If company is losing market share, that means price increase is not sticking. Treat the above 3 points as a checklist to understand whether a business has an edge or not. So, from now on, you must add a pricing power checklist to your investment analysis. So, pick a company, look at a price and volume trend over the years, track gross margins, and track market share. If you do this consistently, you are on a right path to quality investing. Finally, to end this video, pricing power isn't a story. It is based on figures and data. A rational investor doesn't just trust stories. They check them with numbers and simple checks. Do that consistently and your investing will shift from guessing to critical thinking. And that was it for today's video, and I hope this video was valuable to you. If this video provided some value, please like this video and subscribe to this channel. Thank you so much for watching. I will see you in the next video.